Let's break down a key factor in your financial health: credit utilization. It's simply the amount of credit you're using compared to your total available credit. This ratio is a major player in your credit score. Picture this. You have one credit card with a $1,000 limit. If you charge $500, your utilization is $500 divided by $1,000, so 50%. That's how much of your available credit you're using. The lower this percentage, the better for your score. Why does this number matter? Because lenders see high utilization as risky. A high percentage suggests you're relying too much on credit, which can hurt your score. The good news? You can improve your utilization and your score in as little as a month. Here's a crucial tip. Your statement has two dates: the due date and the statement closing date. Always pay at least the minimum by the due date to avoid late fees and credit damage, but the closing date is when your balance gets reported to the bureaus. Think of the statement closing date as a snapshot, a single moment in time that captures your financial picture for the month. Just like a photograph, it freezes your credit card balance exactly as it is on that specific day, regardless of what happens before or after. Whatever your balance is on that day is what gets reported to the credit bureaus. This number becomes the official record that lenders and credit agencies see when they evaluate your creditworthiness. It doesn't matter if you pay off your card right after the statement closes. The balance that was there at the moment of the snapshot is what counts for your credit score calculation. The snapshot is what counts, not the payments you make after the fact. This is why it's so important to understand when your statement closing date falls each month. That's why your score can swing month to month, sometimes unexpectedly. If your balance is high on the closing date, your score might dip even if you pay it off in full just a few days later. If you have a high balance on the closing date, it can look like you're using a lot of your available credit, which can lower your score. Your score drops, even if you pay it off right after, because the bureaus only see the snapshot, not your payment activity after the statement closes. But if you pay down your balance before the closing date, you can make sure the snapshot shows a lower balance, which can help your score jump back up. Your score can improve simply by timing your payments strategically. Timing is everything when it comes to managing your credit profile. Find out your statement closing date for each card you have. You can usually find this information on your online account or by calling your credit card company. Set a reminder to pay down your balance a few days before that date each month. This way, you'll always be prepared and never caught off guard by the snapshot. This simple move puts you in control of the picture lenders see, helping you present your best financial self every month. Make the snapshot work for you, and watch your credit score reflect your smart financial habits. Let's talk about credit utilization targets, one of the most important factors in building and maintaining a healthy credit score. There are 3 key credit utilization thresholds you need to know: 30%, 10%, and anything below that. If your credit card balances are over 30% of your total available limit, you're officially in the danger zone. Lenders see this as a sign you might be overextending yourself, and it can hurt your credit score. But if you keep your utilization under 30%, you're in the safe zone. This shows lenders you're responsible with credit and can manage your finances well. Want to be among the top credit scorers? Keep your utilization under 10%. This is where the credit pros hang out. People who consistently get the best rates and offers. For example, if you have a $5,000 credit limit, keeping your balance under $2,500 keeps you in good standing and away from risk. But if you can get your balance under $500, you're maximizing your score potential. That's the sweet spot for the best results. Start by aiming to drop below 30%. Once you're there, set your sights on getting under 10%. It's a step-by-step process, and each milestone matters. Don't stress about being perfect right away. Progress is what counts, and every improvement helps your credit health. Every time you lower your utilization, even by a little, you're giving your credit score a boost. Celebrate those small wins, they add up over time. Remember, building great credit is about steady, consistent improvement. Track your progress and stay motivated. Focus on one card at a time if you need to, and don't get overwhelmed by the big picture. Take it 1 month at a time, and before you know it, you'll see real results in your credit score. Ready to take action? Here's your step-by-step 30-day plan to boost your credit score and take control of your financial future. Whether you're just starting out or looking to recover from past mistakes, these simple actions can make a real difference. First, gather all your credit card statements, paper or digital. Carefully review each one and find the statement closing date for every card you own. This date is crucial because it's when your balance gets reported to the credit bureaus. Next, set up reminders on your phone or calendar a few days before each closing date. This helps you stay organized and ensures you never miss an important deadline, which is key to building good credit habits. Before the closing date arrives, make a payment to reduce your balance as much as possible. Even a small payment can lower your reported balance, which can have a positive impact on your credit utilization ratio and, ultimately, your score. After your statement closes, pay off the remaining balance before the due date to avoid paying interest. This not only saves you money, but also keeps your credit in good standing. To make things even easier, set up autopay for at least the minimum payment on each card. This way, you'll never accidentally miss a payment, which is one of the most important factors in your credit score. If you're struggling to pay down your balances, consider pausing your card usage for a month. Alternatively, call your bank and ask for a credit limit increase. This can instantly improve your credit utilization ratio, even if your balance stays the same. By following these steps consistently for 30 days, you'll start to see real progress. Remember, improving your credit score is a journey, but with dedication and smart habits, you'll see your score rise, one month at a time.